Met de zomervakantie voor de deur herhalen we de komende weken een aantal podcasts uit de Masterminds-reeks. Let wel, omdat het al oudere afleveringen zijn, is sommige informatie ondertussen wat achterhaald. Maar de voornaamste lessen en inhoud van de afleveringen blijven uiteraard gelden. Voor we de aflevering starten, een korte disclaimer. Deze podcast is op geen enkele manier bedoeld als beleggingsadvies. Alle cijfers, koersen en bedrijfsgegevens die erin aan bod komen zijn louter ter informatie. Welkom bij Masterminds, een podcast van Inside Beleggen en Trends. Ik ben Jeff Poortmans. Elke aflevering spreek ik met bekende beleggers, fondsbeheerders of analisten over hun beleggingsaanpak, hun visie op de markten en over interessante aandelen en bedrijven. In deze aflevering is Peter Garnry te gast. Hij is hoofd van het aandelenteam bij Saxo Bank in Kopenhagen. Ik heb Peter voor de podcast gevraagd omdat hij een in mijn ogen heel interessant stuk had geschreven over de opbouw van beleggingsportefeuilles. Heel veel beleggers denken namelijk dat individuele aandelen daar de voornaamste bouwstenen voor zijn. Maar volgens Peter is dat niet het beste vertrekpunt. Hij zegt dat elke beleggingsportefeuille 2 hoekstenen moet hebben, namelijk beta en alfa. In de podcast vertelt hij precies wat hij daarmee bedoelt en hoe beleggers daar hun portefeuilles mee kunnen opbouwen. Verder gaat het ook nog over de rendementsverwachtingen daaraan verbonden, over de verschillende thema's waarin hij belegt en over zijn meest gedurfde positie en hoe hij daartoe gekomen is. Maybe before we get to the meat of our conversation and of the article that you've written, could you briefly take us through your career as an investor, how you started out and what you've done since then and what you're actually doing right now at Saxo Bank?
Yeah, so I think my start with investing was around when I was 18 years old. I got some money my parents had saved up. I quickly learned a little bit about investing. I followed an investment newsletter, and I didn't know a lot of things about investing, so I just did some investing back then. And it's funny looking back in hindsight, when I was in high school, when I was 18 years old, I vividly remember one of my classmates coming by with an Apple iPod saying, "Look at this iPod. I mean, this is the future."
Okay.
And looking back, I mean, if I had bought Apple stocks back then in 2001, it would have been a fantastic investment.
Same, yeah, I have the same experience with Google. I started watching it in 2003 without doing anything. I did it, yeah, it kept to watching.
Yeah.
And then, yeah, you went on to professionalize your skills as an investor later on.
Yeah, I took A courses in mathematics and physics and chemistry in high school, and I actually thought I was about to be an engineer, following my dad's footsteps. But back in my head, this investing and finance was bubbling. So I ended up actually going to Copenhagen Business School, and I was doing a master degree in finance and accounting, and then together with 2 other guys, we actually dropped out of our master degrees and started. We wanted to create a Bloomberg Lite for private investors and small banks here in Denmark, and it was a very nice web application. And we had our own proprietary data, and we had an okay start. And we were actually offered a monthly subscription on credit cards, which was very unheard of in Denmark in 2007, I can tell you. But it worked okay, and then the financial crisis came, and we couldn't distribute very easily through banks because they were going into survival mode. And we ended up actually liquidating the company in 2010. And at that point, we had some employees, we had some business angels / venture capital, and I just didn't feel like I wanted to go back, so to speak, career-wise onto school. So by some pure luck and accident, I happened to stumble into Saxo Bank, which that company in Denmark had always fascinated me because of the entrepreneurial angle. And then I just did a CFA, which was brutal on the side, and that was basically my entry into investing professionally. But then, sort of on the sidelines, coming back to when my initial investing, following a newsletter. After that initial experience, I lost some money, and I thought, okay, I don't know anything about investing. And then I stumbled, like I think most young people, into Benjamin Graham and Warren Buffett, and I became a value investor, and that it cost me a lot of money because I was investing in a lot of so-called value stocks, which happened to be banks in 2008 and the mining companies. So I lost a lot of money again in 2018, and that was a brutal experience. And then quickly, after that experience and at Saxo, I met a guy, and I began to program and I have programmed ever since. So now 11 years in R and Python, and I got into this whole quant thing and momentum factors and value factors. And then in 2015, I think was the pivotal moment for me where I gravitated away from this quant stuff to looking more at asset allocation and growth investing, which is sort of those ideas over the past 5 or 6 years is basically the principles or the root of my article.
And then now you are head of quant strategies for the equities team in Saxo Bank. Am I right?
Yeah, and head of equity strategies, so sort of a split role.
And what's the gist of your day job? What do you do day in, day out for Saxo Bank then?
Every morning we have something called a quick take and a podcast where we go through everything that has happened over the past 24 hours. That's a multi-asset effort by our entire strategy team. Then we write, a quarterly outlook. We write daily updates on the market. We also do on the quant side. We do make different types of analysis where we crunch the data in a more statistical way. And then recently, I would say over the past 2 years, we've sort of launched this new effort, which we'll talk a little bit about in the podcast as well when we talk about the alpha in a portfolio. We've sort of gravitated more and more towards themes at Saxo because it's an easier way to, I think, digest the complex financial markets, and it's an easier conversation to have with private investors. I think they get the idea of themes much better than talking about a momentum factor or a value factor, which gets a little bit too arbitrary sometimes.
Yeah, and so the reason for getting you on the podcast is, as I said, you've written a couple of weeks ago, you've written a very worthwhile and interesting article, I thought, where it was called The Equity Strategist Guide to Wealth Management. The listeners can go and check that out. It was somewhere beginning of September on the Saxo Bank website. They can find that. Maybe to start off with, the starting point for your analysis is actually that many investors, when they start investing or when they start thinking about investment strategies and portfolios, they start off using the wrong assumptions. Could you explain that a little bit more? What do they have wrong, or what do many investors have wrong when they start out, and what should their starting assumptions be instead?
I've come from the same place, and I meet a lot of these newcomers to the investment world through my job. And the single thread or the red thread here is that a lot of people, and I did it myself 10 years ago when I dabbled in markets initially, and we tend to be brought up with finding single stocks, and when we start investing, we probably don't have that much money, so we think, why should I have a broad portfolio? When you have a little bit of money, it wouldn't make me a lot of return in nominal terms, right? If you only have, let's say, 5,000 euros, if I have a well-diversified portfolio, it doesn't make me any money. So we tend to be drawn into this idea that we'll find the winning stock. And when I talk to clients, that's typically the first question I get. So which stock should I buy? And it's just the wrong way to approach markets, because you really need to get into the helicopter and start being humble. And I've learned it the hard way. I've lost my share of money over the years. And you have to be humble and basically say, okay, let's assume that I'm not an expert in anything. What is the return I can extract from the market in a low-cost way? That should be your starting point. And then you should think about, okay, so how do I get that market return? That should be the core principle. So you see, it's a very opposite way of starting the conversation.
When talking about that expected market return, in investment jargon, this is called beta, right? Which should be one of the building blocks of everyone's portfolio, if I got it correct from your piece.
Sure. And I have to be precise here. When I talk about the market portfolio, it's not the MSCI World, so the index that tracks the 23 largest developed equity markets in the world. That's the equity market, one of the broadest definitions. But when I'm talking about a market portfolio, it is basically the idea that if you had infinite amount of money and you could buy all securities in the world, how would your portfolio look like? It would be a mix of government bonds, credit bonds, equities, real estate, private equity, commodities, gold to some extent. All these things, that's your market portfolio. And the beta concept comes from regression analysis. So if you have this market portfolio, you can regress things against it. So for instance, if you have a market portfolio that is very well diversified, then equities would have a beta above 1. So most equities would add market risk to your portfolio. And very low duration bonds, government bonds, would have a very low beta to that market portfolio, so they would de-risk your portfolio. In the same sense that a growth stock in Belgium would have a beta above 1 to the MSCI World, meaning that when the MSCI World is up 2% on a given day, this growth stock would be up 3 or 4%.
I gather that many investors, even when they talk about beta, they sometimes think of it in a too narrow a way, thinking that it's only beta to equity markets, but you should have beta to basically all the financial markets that are available to investors, if I get it correctly.
Exactly. So it's and the cool thing is that we've got this wonderful ETF product in the world. It started in 1993 with the ETF on the S&P 500, and it has since gone on a world tour and entered basically all markets, and we have it here in Europe as well. It has become a very low-cost way for investors to get access in a very broad, diversified way. So my own beta portfolio has a universe of 14 different ETFs that tracks short-term government bonds, longer-term government bonds, high-yield credit, investment-grade credit, which is companies like Coca-Cola and Apple, Nestle here in Europe, commodities, gold, emerging market equities, which is China, India, MSCI World, which is the equity market in Belgium, Denmark, and the US, and you can get access to private equity and real estate, not to forget, which is a very interesting asset class because it's such a big part of our economy, and you can get access to all these different subcomponents or asset classes for an average around 30 basis points, so 0.3% per annum. That's very low cost.
And then when thinking about the construction of the beta part of one's portfolio, so ETFs is a very good instrument to get exposure to the beta of the many different financial markets that we have available. But how should one think about constructing it and the weights one allocates to the different financial markets that you want to get the beta of? How did you think about it? And is it something that you periodically have to reweigh and reassess, or is it a one-time thing?
Ideally, you should reweight or update your because it's a function of market expectations basically and the returns. So it's not a static thing, although you could implement it as a static thing. There are many approaches to this. So my own approach comes from the fact that I have been programming and looking at quantitative data in financial markets for 11 years. So I apply a rather sophisticated approach to it myself, but and that's probably out of the reach for most people, but there are several options. So Harry Markowitz, which is you can say the father of modern finance and sort of adopted this new idea of portfolio optimization, etc. He went, I think, in a speech many decades after his initial seminal paper from, I think, 1952, if I remember correctly. He basically said, I've come to the conclusion that it's almost impossible to do optimization. So I prefer a 50-50 split between bonds and equities. That split probably worked pretty well from the day he said it. I'm not so sure that split would fit today's world with those very low interest rates and potential inflation lurking on the horizon. Most investors, I don't know what type of offerings you have in Belgium, but in Denmark here at least, and I presume it would be the same in your country, there have been a new offspring of a lot of different automated investment strategies or asset allocations that use ETFs. And in Denmark, and also here at Saxo, we, in a collaboration with BlackRock, you can get these balanced portfolio, which is a balanced portfolio of all these different asset classes I mentioned. And in Denmark, you can get them for around 0.5%. I think that's a very low-cost offering for getting this balanced portfolio where someone will update it for you. So I would say 90% of all investors should think about going down that path for the beta portfolio.
Yeah, because I presume if you want to do it yourself for the beta part, you need certain macro insights to be able to do the proper allocation, right? Know that commodities next year we can expect such and such, and that relates to credit and equities in other ways, which adds another layer of complexity to investing if you want to go that route.
Exactly, and it would be quite difficult, because how much would you put on credit and government bonds? I mean, if it's a true market portfolio, the weight allocation should represent the value of the asset class totally, of the world's total value. So real estate, equities, and government bonds and investment grade bonds, those would be the four core components in the portfolio, and it's not 25% for each. So it is a little bit difficult, and as you said as well, you have to take into account the return expectations, because the return expectation for European government bonds today, for instance, is probably negative, right? So it is a little bit of a difficult job for most people. So that's why I'm saying, I mean, if you can access these automated asset allocations, that would be best. The second best option would be to think about creating a mix between government bonds, credit bonds, real estate, and equities, because those four pillars are the main pillars of global financial markets. And equities are larger than real estate, so equities should probably have twice as large a share as real estate, and government bonds should be a little bit bigger than credit bonds.
That wraps up the beta block, the beta part of portfolio that, according to you, should be a significant part of everyone's portfolio to capture the exposure to general markets. But when it comes to thinking, because the next building block is alpha, which we'll talk about in a couple of minutes, but when it comes to thinking of the allocation and the division of allocation to alpha and beta, how should one think about that? How many percent of my portfolio should I invest in the beta part, and how many should I invest in the alpha part?
Yeah, that's a very good question, and it's the question I've got from a lot of clients when I wrote this piece. And my own split is 70% beta and 30% alpha, and the alpha part has probably gone up a little bit over the years. And the way you can think about it is that your alpha part of the portfolio is a function of many things, but it's a function of your age foremost. So the older you are, I think the less emphasis you should have on the alpha part. It's also a function of your income. It's also a function of your risk tolerance and expectations for the market. So right now we have very, very high equity valuations. That should have a negative impact on how much you want to allocate to your alpha portfolio, just naturally. So and a very simplistic way to think about the alpha portfolio, I think in its purest form, it expresses your own confidence, right? So the more confident you are, the more you would allocate to your alpha portfolio. And I think anyone's starting point, that's what I try to emphasize in the article, everyone that starts with investing should start with 100% in beta, and then slowly roll up or increase the exposure to the alpha portfolio, basically.
Nevertheless, as you say, for you it's 30-70. For others, it could be something else. But when you look at the alpha part of your portfolio, what are you looking for to be able to construct that part with?
As I said earlier in the podcast, I've changed my view on equities over time. So I started by this random investor looking at investment newsletters. Then I turned to value investing with Benjamin Graham. That led to terrible results in 2008 because of my exposure to mining and banks. Also, we have clients that talk about dividends, etc. And I'm very opinionated about this, because the more I think about it, the more I've come to the conclusion that alpha, and the reason why we have single stock exposure in equities, for me at least, is to get the growth component, because the growth component is basically a function of productivity growth and innovation. That's what you're getting in the equity asset class. That's why we have it. It's a risky asset class. The dividend stocks, just to take that, is basically it's companies that have no imagination, and to be quite rude, they don't have any imagination to expand the business beyond just paying most of the surplus profits to shareholders through dividends. But if you look at a lot of the dividend strategies, you can get the same return stream by just investing in high yield bonds, and you can get that very cheaply with an ETF, and you have a better position in the capital structure. So basically, legally, if anything trouble happens, you are first in line, or at least you are in line in front of the shareholders. So that's why when there is a downfall for a company, equities tend to have a steeper correction than bonds in the capital structure, or the balance sheet, if you will. So I think you should go for the growth component. And if you think about it, this is something I also talk to our clients about. If you look at companies like Amazon, or you look at a company like Zalando, who are here in Europe, or whatever it is, it could be Adidas, it could also be Apple. All these companies that become very big and part of our main equity indices, just mathematically, you cannot get to that point unless you were growing faster than anyone else, or at least much faster than the average. That's the definition. So to find tomorrow's winners, you have to bet on companies you believe can grow faster than the average company. And I think that is actually, in its essence, the exercise you're trying to do in the alpha portfolio.
And yeah, with this growth potential or this search for growth potential comes a higher risk, I presume. How should investors think about that? And how do you think about that?
That's absolutely correct. And the way I look at the alpha portfolio, when I invest in a stock, and I have some of the stocks in my portfolio I have owned for 8-9 years. If you have a very long-term horizon, risk is a very different concept than if you talk about one year horizon, where basically any company could be down 20% for whatever reason. And I think, as you correctly say, when I put on, because you have a core portfolio which is in the market portfolio, the beta portfolio, you allow yourself, I think, mentally, because you sleep well at night because of the core portfolio, you make room for yourself to invest in more risky opportunities. And then we come back to the thinking about themes, because that's the way I think about alpha portfolio. So I'm looking into the world and I'm trying to be imaginative and say, what kind of trends, what type of society do I think is most likely to be happening over the next 20 years? So that could be, for instance, okay, I believe robotics and automation technology will be a very, very significant growth driver because of the demographics in the Western world. Okay, and then as a function of that idea or that vision for the future, I get some exposure to robotics or automation companies.
Yeah, because you mentioned some of the themes that you've allocated to. Yeah, could you take us through some of them and why you think those are worthwhile looking at?
Sure. So I can mention my most risky stock, actually, which I happen to invest in by an absolutely pure accident or randomness, if you will. And this is a very good lesson for the listeners as well, to be open-minded. So I'll get you the idea here. So I come into work this morning and my chief suddenly says, "Peter, have you looked at this company called Bold Corporation?" And I'm thinking, Bold Corporation, never heard about this before. And it turns out to be the biggest producer of tin cans in Europe. So tin cans for tomato soup or whatever it is, right? And he says, Wall Street is betting on this. This is around 3 or 4 years ago. He said, Wall Street is betting on this because of the problem with plastic in the oceans. That was a huge topic. It still is, but it was very much in the news 3 years ago. And then I talked to my colleague and we said, it cannot be that digging metals out of the ground is the solution to our plastic, because plastics, we have to be honest, has some very nice properties about you can form it in different ways. It's transparent. You don't have to dig it out of the ground. I mean, it's lightweight, etc. But we know plastic is not decomposable, so it has some downsides. And then I looked up in the Bloomberg terminal. I said, okay, there must be a company that is making plastic in bioplastic or plant-based plastic. And then I happened to come across this company in Canada called Good Nature Products. And they spent 7 years trying to develop a plant-based plastic that can decompose in nature within 6 months. And I said to myself, okay, I think plastic is one of the biggest challenges we have, except for climate change in our world. And I said, you know what? I don't care about this company, whether they lose money. I just need to have exposure to this theme, and therefore I invested in the company.
I mean, in this case, you came across one opportunity. What if it were the case that there were 3, 4, 5, 6 of these biodegradable plastic producing companies? Then how would you go about it? Would you then start triaging between those different ones and seeing which ones would come out best?
It's very few themes where I have 2 stocks. I'll give you one theme where I have considered making a split. So I like the cybersecurity theme very much, and I like it for several reasons. So one of the reasons is that cybersecurity spending is expected to grow between 10 and 15% for at least the next decade. We all heard the stories about banks and governments being hacked. It's an increasing problem. And we have this home improvement retailer in Denmark, and they were hacked, I think a year ago, and their online systems were down for 4 months, so they couldn't get any online orders. And the CEO made this comment in the newspaper that this was worse than the pandemic. Cybersecurity is becoming a necessity for all companies, and I invested in cybersecurity industry by buying, I think they are the biggest cybersecurity company in the world, or at least number 2. And they're very profitable, massively free cash flow generating. So this was very a solid company. So and growing at around 20% per year. But they don't have the newest technology. There are other cybersecurity companies that are more on the forefront of this, venture into cloud. And this is where I have thought about, splitting actually my cybersecurity investment into the number 1 and number 2 leader in the industry that is safe and profit generating, and then making a bet on a newer technology, but a company that is not profitable.
One last question on the alpha part. I was wondering, how do you think about turnarounds? But because you mentioned the high growth potential, but are turnaround companies also possible candidates, or is it something worthwhile looking at?
They could be cases where there is a turnaround. So I have 30 stocks in my alpha portfolio, which probably is unusually big alpha portfolio for most people. I think maybe 5 to 10 would be more normal. I have a few which you could call a turnaround case. This again, it's not an investment recommendation, but one of my holdings is in Hinds and Maurits, H&M, and I think that one is a turnaround case. It's and it hasn't been a successful one, to say the least. So most of my stocks are companies are exposed to a high growth theme, basically. But I have a few exceptions, and H&M is actually one of them.
Yeah, and then as you said, your thinking is based around the beta part and then the alpha part. But one aspect or factor that investors also should take into account is their return expectations for those 2 parts of their portfolio, for the beta and the alpha part. How can they think about what they can expect for those 2 portfolio parts?
It's a very good question, and I want to start from a different angle. I have a lot of young colleagues in their 20s, and it hasn't dawned on me until recently, because I've talked to them about cryptocurrencies and investing in general. And to me, it seems that there has been a shift over the past 5 years where investors, and especially young people's return expectations have gone madly high. I mean, so high that you just know mathematically it's not possible. It cannot be this high, right? I mean, they tend to think that if it cannot double within a year, it's not interesting, which I think is a very dangerous mindset to have. The fact is that we live in a very low interest rate environment, and the real interest rate, so when you adjust for inflation, is negative in most parts of the world. It's a function of many different things, but what it tells you is that the return expectations are very low. So in government bonds today, your return expectation is somewhere between slightly negative and positive. If you look at the S&P 500, which is the largest equity index in the world, its estimated risk premium is somewhere, depending on the methodology, somewhere between 3 and slightly more than 4%. If you add that to the US 10-year, which is slightly above 1%, you get to somewhere between 4 and 5%. That's your long-term return expectation for S&P 500. Then it's a little bit more for emerging markets. And then credit, investment grade, and high yield lies somewhere in between the 4% equity return and then the 0 for government bonds. So you can see, if you stitch together a beta portfolio of these portfolios, you're a balanced portfolio today. Unfortunately, is not expected to generate much more than around 3 or 4%.
It's not very encouraging.
No, and that is. I have applied a method on my beta portfolio that has lifted that return expectation. I think I write in the article, I think I can crank out 6.5%, but that's because I've managed it a little bit more actively by trying to mitigate or reduce something which is called a tail risk. So very very volatile down days. But for most people, if you just have a long only balanced portfolio, your return expectation is closer to 4%. So what happens is that because of these low return expectations, I think most of the listeners would think, geez, that's very, very, that's a very low return. I think I need to have more in my alpha portfolio than Peter, which is at 30%. And I fully respect that decision. And there is no right or wrong answer to that allocation question, because it is really a function of your mindset and your risk tolerance, basically.
And then you, for yourself, for the alpha part, you have also devised a certain expectation when it comes to returns. And how should investors think about the expected returns that they can have from their alpha portfolio? Does that also depend on the type of stocks they use? As you decide to put a lot of your portfolio in growth stocks, hence you might expect a higher return than if you were to put it to cyclicals and value?
Yes, exactly. I mean, my bias in the alpha portfolio is to go for high growth opportunities over a 10-year horizon. So there's a bias towards growth oriented themes. So it's cybersecurity, robotics, fertility treatments, plant-based bioplastic, carbon capture, fuel cells technology, all these things. And there's a bias towards the small cap stocks, and intrinsically from those two principles, you would expect a higher return. So I formulated in the article that my return expectation for this alpha portfolio is 20% a year. And so far, the last 5 years, I have done much better than those 20%, although I think that's probably a function of a lot of luck. I think we have to be a little bit lucky in this world to do well. But I think that's the principle of the alpha portfolio. You should have high expectations. And when I talk to clients, and I guess also your listeners, if you're a normal private investor, your biggest weapon against the professional investors is that you can go places where most professional investors can't go, because they're either too big or they have certain limitation or constraints for whatever reasons. So I think that's the biggest weapon. Also, because if you as a private investor buy a smaller company with a fascinating technology, betting on some theme, if it turns out you're wrong, you can get out pretty quickly because you're a small investor, so you don't impact the market. So that's, for instance, the Good Natured product. It's not a very big company in Canada, so I can get out. Whereas if you're a big pension fund or a big hedge fund or a big long only equity manager, you cannot take these risks. You cannot go for these opportunities. So I think there's so much interesting room and creativity and imagination around that alpha portfolio that you can apply if you're a private investor.
Yeah, and then finally, because when taking this approach of alpha and beta and devising your portfolio between the two, is it a lot of work as opposed to general stock picking and investing? And what's your advice for investors who want to start to implement this approach a bit?
I look at my beta portfolio and update it quarterly. So every 12th week, I update it. If you have access to these automated asset allocation strategies I talked about, then you don't have to do anything. Then you only have to think about the alpha portfolio. And if you apply the same mindset as I do on the alpha part, then you invest for the long term. So then it's not a big work on doing intensive analysis. Then it's actually more fun in the sense that you just read a lot of interesting articles and be open. I mean, my carbon capture investment was actually because I just read an article in the Wall Street Journal, and I read that Chevron in the US was investing in carbon capture, and I was like, carbon capture? I didn't know anything about that. And then I stumbled across that Bill Gates thought it was one of the main pillars of the green transformation, and then I tried to find a company that had technology in carbon capture. So I think actually it doesn't have to be a lot of work. It actually it can be quite fun because you read up on a lot of interesting technologies and you think about the future. The beta portfolio should be as low maintenance as possible. It's the alpha part that is the fun part, and where you can spend a lot of time if you want to.
Yeah, how investors also need to be a bit of a futurist.
Yes.
Thanks very much for your insights and your time. It was a great conversation and lots of valuable things to think about. So thank you very much.
Thank you so much, Jeff.
Tot zover deze aflevering van de Masterminds podcast. Bedankt voor het luisteren en aarzel zeker niet om hem te delen met familie, vrienden en kennissen en om een recensie achter te laten via uw podcast-app.
Deze podcast kwam tot stand met de gewaardeerde steun van Keytrade Bank, de onbetwistbare marktleider in online trading in België.